Well, while our panelists are making their way to the podium and table, I'll introduce myself. I'm Richard Kaufman. I was for many years staff economist and general counsel at the Joint Economic Committee in the U.S. Congress. The committee, by the way, was chaired by a number of chairmen during my tenure, one of whom was Paul Sarbanes, who was co-author of the Sarbanes-Oxley Act. Another was Lee Hamilton, who was co-chair of the 9/11 Commission. And another was Henry Royce, who was a major proponent for the floating dollar and other useful international institutions. Let me make a couple of introductory comments, and then I'll introduce our panelists. Charlie Parker and Dizzy Gillespie were mentioned at the first panel, and if bebop jazz could be alluded to in this meeting, I might be excused for bringing up the subject of war and peace. My Capitol Hill career occurred almost entirely during the Cold War period, when Cold War economics was taken for granted and virtually all policy was viewed through the prism of that war. In the immediate post-Cold War period, military spending was modestly reduced and the budget was balanced before the defense budget turned up again in anticipation at the end of the 1990s of the 2000 elections. In the present era, war issues are once again, directly or indirectly, infusing much of economic policy analysis and economic policy. This can be seen even in discussions about the dollar. According to one school of thought, the dollar's decline is symptomatic of the U.S. decline generally as a world economic and military power. And according to this line of reasoning, we ignore at our peril the rise of China, whose currency remains steady as the new dominant economic and military power, as well as an economic and military threat to the United States. There are, of course, other views of the causes and consequences of the decline of the value of the dollar and ideas about what, if anything, should be done about it. Let me then turn to our panelists. Pierre Calame, I hope I'm pronouncing it correctly, is the General Director of the Foundation Charles Leopold Meyer and a member of the Founders Committee of the China-Europa Forum. Jane DiResta is a former staff economist where I first knew her at the House Banking and Commerce Committee, and now a research associate at the Political Economy Research Institute of the University of Massachusetts. Jan Kriegel is a senior scholar and director of Monetary Policy and Financial Structure Program at the Levy Institute at Bard College, and we will first hear from Pierre Calame.
Thank you. I apologize for my English. I'm afraid I'm the only non-American in all those panels. So I will look at the issue of dollar from a European point of view. Let us look at the dollar situation 1 year after. The only thing we can say is that the fire has been contained, at least for a while, with an immoderate flow of currencies putting the future burden on the shoulders of ordinary citizens. Dollar has not collapsed as it could have. the interdependency between China and the US, the impossibility for China to conceive in the short term an alternative to reserves in dollars made it that it even kept buying treasury bonds at a zero interest rate or so. So did millions of institutions and people, because they could not see any alternative in a context of risk aversion. But the paradox is that the very reason which would have brought to flee from dollar and treasury bonds as reserve of value, the risk of collapse, has strengthened this role, let apart the rise of gold, because all those who yet had enormous amounts of this reserve in their balance sheet could not afford the risk to see them vanish. And after a short while, at the end of 2008, the aggregate reserve of changes in dollars has resumed. It means that there was no alternative to the dollar in the short term. China leaders are obsessed with the risk of a slowdown of their growth, all the more so at the sensitive moment of the 60th birthday of the communist regime. So they kept the yuan anchored to the dollar, and furthermore, it is not convertible. So it was not an option. Euro neither can nor want to be a unique alternative to the dollar. It is presently suffering from the evolution of the dollar, which can be, in fact, seen as competitive devaluation. G20, until now, mainly concentrated on bank regulation, and very few has been done about the issue of a future international currency. But everybody is thinking of it, or at least should, because none of the structural problems have been fixed. Look, for example, at the commercial imbalance between China and the US. China government has launched an enormous stimulus package, and China's growth will probably be 2 digits at the second semester. But where did the money go? To the development of domestic demand? No. Part to new infrastructures from the local authorities, part to the development of new capacities by the state-owned enterprise, most of them yet with overcapacities, and part to a real estate and assets bubble. For the future, the recent Guangdong Fair showed that foreign orders for exported goods had resumed. Therefore, there is no short-term reason for imbalances to be reduced, and both sides are nervous about what could become a serious trade fight. Public opinion is in anger to see financial institutions, which have threatened the whole society with their irresponsible and unethical practices and have been saved thanks to the public efforts, go back to business as usual, even when it comes to executives and traders' compensations. And the renewed profits do not come from socially fruitful long-term investments or from a grand strategy of conversion to a greener economy. It comes mainly from short-term speculation on currencies and on energy and commodity prices. Stability of currencies and previsibility of the evolution of the cost of factors, as should be the case for energy if we want to move towards sustainable development, are paramount for real economy undertakings. But there is a growing suspicion outside US that the present US administration pays too much attention to Wall Street interests and arguments, as if the future of the US economy, society, and power would be bound to its role of financial superpower, with profits from the financial system representing an undue part, up to 30% of the total. Because none of the structural problems has been fixed, more than ever, we need to prepare a new enlarged Bretton Woods. Enlarged in 2 ways: the way the different countries will be represented and the scope of the negotiation. It needs a careful preparation and a number of deep conceptual and institutional innovations. In order to succeed, we need an agenda, just as it has been done for the Earth Summit in 1992, or for the Kyoto negotiation? Let's say a new Bretton Woods 5 years from now, in order to prepare it seriously. What could be the scope and the proposals? I would suggest 5 issues. First issue is the stability of the exchange rates between 4 major regional currencies. And I can see Americas, North and South, first. Europe, including Russia and Africa, second. East Asia, including China, Japan, Korea, and ASEAN, third. And South Asia, including India and Bangladesh, fourth. Whether the exchanges between these regions be labeled in dollars or a bunch of currencies is less important than the coordination of policies needed for this stability. 2, a regional monetary system in each of these 4 regions. China and ASEAN seem yet to move in this direction with their new free trade agreement, which will favor the development of the yuan as regional currency. And on both of these issues, the global regional currencies and the monetary system inside each region, I think the way European Union came to euro in 20 years through the preliminary processes of the European monetary snake, then the European monetary system, gives a fairly good idea of what could be done at the world level. The third issue is a new approach for energy and commodity management. First of all, one must understand that the concentration of fossil energy resources in a relatively limited number of countries is, from the 70s, at the core of imbalances. Everybody is concentrating on the imbalances between China and US, but the imbalances coming from energy is much more structural and important. And that energy is now a full-fledged currency unit as unit of account, mean of payment, and reserve of value, and representing yearly trillions of dollars a year of currency emission. Energy has always been put apart from the commercial international agreements, but it is at the core of any new financial and monetary order. 2 issues should be addressed on that respect. The first one is the short-term stability of energy prices through the creation of global regulating stocks. And second, we need a new regime of governance for energy in order to move towards sustainable societies and interregional justice. The alternative to such a solution is war. One can see it with the desperate effort of China, the newcomer in the development family, to control oil and natural resources in Africa. They have no option. This new regime of governance will necessarily be worldwide negotiable quotas, paving the way to multinational currency, the multidimensional currency. That means that we have to change our very view of what currency is. The fourth issue will be periodic adjustment of imbalances, where we badly need, as it has been said by a previous speaker, international coordination under IMF guidance. And fifth is new rules for pension funds. They are, with fossil energy, our major saving silos and the ones which should naturally be oriented long-term. New regulations orienting these funds in direction of long-term investment, limited transition towards sustainable society in developed countries, and the sustainable development of underdeveloped countries would contribute to rein speculation. Thank you.
Jane DeRista.
Thank you very much. It's a great pleasure to be here and to be toward the end of the program and having absorbed so much interesting information. I'd like to begin by saying that we already have a problem with the dollar. It is in the monetary system itself, because one of the key roles of an international monetary system is to recycle payments imbalances. The inability of the United States now to serve as a consumer of last resort means that the system is already in jeopardy. What we had before was a dysfunctional system, but at least it did that job. I would like to step back a little bit and talk about the components of an international monetary system before I get into what I think we should be doing going forward. First of all, we have a system that is based upon foreign exchange reserves. This means that it's a system that generates credit, unlike a gold-based system, which does not. As a major difference, one that has infrequently been written about or taken into account. So we have also made the assumption that the foreign exchange reserve system that we took on after Bretton Woods was new. It is not. It was the cause of major difficulties in the interwar period. 42% of global reserves of 25 countries in 1929 were foreign exchange reserves. By 1933, their value had shrunk to 8% of global reserves. The contraction of credit, too little written about and often completely ignored in descriptions of the Depression, was a major factor in the global situation. The other thing about the foreign exchange reserve system we have now is that we have to look at both stocks as well as flows. And we've been tending to look at flows, of course, at the moment, knowing that we have deficits to finance in the United States. But the description that I just gave you of the interwar period is a problem of stocks and what happened to those stocks as people scrambled to maintain their value and, of course, in the process, undercut their value. A flow situation goes in a different direction, and that was true at the conclusion of Bretton Woods when the European central banks intervened very, very heavily in the markets, bought dollars in order to reflate the dollar's value, and created global liquidity that played into the other inflationary events and developments in the 1970s. Again, a story that is infrequently told. But the immense increase in global reserves, dollar reserves as they were too, was a very important factor. The third, much more recently, in 2005, and this is a stock story, Japan, with its enormous stock of reserves, was being criticized for that stock and asked to, in some way, reduce the surpluses, et cetera. Big political issue. What they did in March of 2005 was to say, well, we will send the yen out into the world, and gave permission to their banks to lend yen. Japanese banks at that point were discouraged from lending yen. And the effect of this in 2005, between 2005 and 2007, was the incredible buildup in the financial sectors around the global economy. Look at Citicorp's balance sheet went up $1 trillion in those 2 years. The Bank of England talks about its banks as having, for the period from 2000 to 2007, gone up threefold. But this, of course, was all about the liquidity that reserves supplied in the market, the carry trade, the proprietary trading, et cetera, that goes in. So 2 points there, again, to be made. The interaction with the private sector. Foreign exchange reserves have the virtue of being a transactional reserve regime. And that means that they do involve the private sector, and therefore the crisis in the international system or with the dollar may not necessarily be what you think it will be. It is most often triggered by some event in the private sector itself, the private financial sector. So what we need to worry about going forward is, where is the system going to go? The assumption is, we hear all the time that there will be other currencies that will take up the slack. I think Pierre has just made the point that will not happen. So what then is being discussed is the SDR. And at a conference last week, a commentator made this point. Every idea I've heard is tons of years old. What's new here is the politics. And what I fear is that we will waste a crisis, which we already have, which is already unfolding, by ignoring it and the fact that we need to revise the international monetary system to reflect that crisis. So SDRs, the problem with SDRs is they are only capable of transactions between central banks. They're not a transaction they're very good as a store of value, unit of account, but they don't fulfill the transaction part of the program. None of the proposals that have been put out, their substitution account, et cetera, will overcome these problems that have emerged with that. So what do we want to think about going forward, since that's all we have at the moment on the plate is the SDR? There have been more grand proposals that have come out of the Keynesian clearinghouse arrangements and built upon them as a way of clearing accounts and putting reserves back in the international arena, et cetera. They are criticized very recently and frequently as being too grandiose. Not possible. We're not going to go there. So let's move back to the SDR, which we know about and which we sort of understand. I think that if we want to go into the future, we have to recognize that we're going to be living for a very long time with foreign exchange reserves at the crux of the system, and that these are credit-generating instruments. Now, the clearinghouse program that I briefly mentioned, which others and myself have proposed, looks at the financial aspect of it and how you do the clearing in the financial sector. But the alternative might well be a fiscal arrangement in which you had a global authority issuing bonds and requiring, if you will, that the member countries of the global authority actually buy those bonds and use them as reserves. They could be funded in many currencies, and the income from the bonds then would be used for public purposes. They would be used, obviously, for development, for infrastructure, for climate change, for medical research, for all the public goods that a public body is responsible for taking care of. But do it at the international level. And the member countries then would be guaranteeing, of course, the value of these bonds, not in terms of interest rates, exchange rates, but the face value itself, so that people would be repaid. I think that, therefore, you've got to look at the system in a very fundamental way. Pierre has mentioned the need for a new Bretton Woods. That's absolutely true, and we should be thinking about it not just in the financial terms, but also in the fiscal terms of the global economy and how the system would work in balancing payments imbalances. Thank you.
Our final speaker on the panel and for the entire event is Jan Kriegel.
Thank you very much. Is this working? You hear it? You got it? Okay, great. I think the best way to start out is by asking a very simple question of those people who would like to replace the dollar or replace the current international financial system. And that is just exactly what is the problem do you think you are going to solve by doing this? And if we can identify the problem, then we ask the question, what is the alternative solution? Now, if we look at the complaints that have currently been made, and it is a bit strange in the midst of what is a near global financial meltdown and massive unemployment, to find people worrying about, at this stage, fixing the international financial system. One of the complaints is that the large holders of dollar reserves are worried about the value of their reserve holdings. Well, one very large holder of US dollar balances held agency securities, and when the Treasury was about to allow Freddie and Fannie to go bankrupt, intervened in order to engineer a U.S. government bailout of Fannie and Freddie in order to bail out the foreign holders. Are we really going to bail out all of the foreign holders of all of the U.S. government securities? Obviously, we are not. Obviously, we cannot do that because the only thing that we can do is to provide them with more dollar balances. So the question is, does it make sense for a foreign holder to complain about the loss of the value of their holdings? After all, these are financial assets. If you had bought AAA CDO tranches and you lost money, I'm sorry, you lost money. You don't get bailed out. Well, in fact, we did bail some people out, but we bailed our own people out. We're not likely to bail out foreign holders. So this first idea is that somehow or other foreign holders have to be given a guarantee in terms of the international value of their dollar holdings is economic nonsense. It cannot be done, and it makes absolutely no sense. Finally, they always have the possibility of holding something else, and clearly they have chosen not to do that. Second point, perhaps it's the volatility of the dollar exchange rate. The exchange rate has been very volatile, and it tends to move up and down. Unfortunately, it tends to appreciate when people don't expect it to, as it did in the last crisis, although anybody who had watched any of the previous crises, for example, the LTCM crisis, would have noted the first thing that happens when you get in a liquidity crisis is that the dollar appreciates and everybody buys treasury bills. But that volatility is basically due to what? Well, it's basically due to the fact that foreign exchange is currently an asset class and investors invest in foreign exchange, and that's one of the reasons for the volatility. Second is that because countries have independent national monetary policies, interest rates tend to differ, which creates a large arbitrage flow of interest rate arbitrage across currencies, which also produces instability. And finally, there's a very simple solution to this sort of flexibility. We can go back to fixed exchange rates, which nobody seems very interested in doing. We really don't need to change the dollar or substitute the dollar to go to that particular solution. Indeed, it's extremely interesting that if you look at the news wires this morning, you will find that virtually every national bank that has substantial dollar holdings is increasing their dollar holdings, basically because they do not want their currencies to appreciate and they don't want the dollar to move in the other direction. So that in fact, while most central banks are complaining about the loss in the value of the dollar, they continue to buy it, and they continue to buy it simply because, presumably, they are unhappy with the way the floating exchange rate system tends to resolve global imbalances. Now, there is another simple solution to that particular part of dollar volatility, aside from fixed exchange rates, and that is that we remove foreign exchange as an asset class. That is, we introduce some sort of international capital controls. Brazil has already done so. Argentina currently has those controls. Many countries, Chile has had them. And in fact, if we go back to the original framers of the Bretton Woods system, the presumption of the entire Bretton Woods system was that it would be based on a system in which there were very few international capital flows intermediated by private financial institutions. Indeed, if we look at Jane's proposal of this global authority issuing bonds, in fact, one of the ideas was it would be the World Bank who would be the issuer of these particular bonds, and they would do all of the international financing. That is, most international flows would take place through international financial institutions. So that's another alternative which does not necessarily require replacing the dollar with something else. The basic bottom line to all of this is that the Triffin paradox, which is really the classic criticism of the international system as it emerged from Bretton Woods, is that any system that is based on a national currency will create what Triffin called the paradox, and that is the paradox that the national policies of the country may conflict with the national policies of other countries, creating the necessity for international policy coordination, which must by definition fail. So the problem that we have here is not replacing the dollar with something else. There is nothing else that we can replace it with in terms of another national currency or a composite currency such as the SDR, which is simply a basket of existing national currencies. So having exhausted that, we then have to move to say, is there some other type of asset that we can create? Some sort of external currency to do it. Jane has mentioned that the SDR, in fact, is not a transactions currency, and it's interesting that the proposals that were made, for example, the Keynes proposals, deals with an international currency unit that is not a transactions currency. That it does not circulate, it is not traded, it is not part of foreign exchange speculation or arbitrage transactions. This is a very natural possibility, but it still leaves us with the question of what we are going to use as the international transaction currency. Okay, we cannot escape the problem that we are going to have to use something, and that something is still going to be the dollar, for the very simple reason that there are great efficiencies involved in using a single currency for international settlement and for specific international transactions. So that if we look at that particular approach and we say we would like to create some sort of international transactions currency, well, let's think of our own currency. It's issued by the Federal Reserve. The Federal Reserve has a balance sheet. Balance sheets have assets and they have liabilities. U.S. dollars are liabilities. They're liabilities of the Fed and the U.S. government. They are backed by assets. What are the assets? The assets are U.S. government debt, basically. Who is going to provide the equivalent of U.S. government debt for the international currency? Obviously it's going to be the international government that is going to issue international debt and is going to engage in international expenditures, in international fiscal policy. Well, here in the United States, we're currently having a debate about whether or not it is possible to expand fiscal policy sufficiently in order to reduce 10% unemployment. Can you imagine what sort of difficulties we would have in deciding what the size of the international deficit would have to be in order to support global full employment? This brings us back to the bottom line, which was that if you look at the proposals that were set forward at Bretton Woods, there were two basic lines. One was currency stability. Let's keep the value of assets stable. This is a very sensible policy if you have assets. If I have a portfolio, I am very interested in stabilizing the price of my financial assets. On the other hand, if I'm a worker, my only asset is my labor, and I am very interested in stabilizing the value of my labor power. Keynes' proposal was a proposal not to stabilize the international value of currencies. It was a proposal to ensure that the international financial system allowed countries to run policies of domestic full employment. And this related to what he called the international adjustment mechanism. That is to make sure that countries that found themselves in difficulty did not have to contain their domestic policies and increase their domestic levels of unemployment simply in order to stabilize the external value of their currency. There is a conflict. There is a trade-off. Our problem is to design an international financial system that has only the objective of stabilizing the value of the holdings of the external possessors of U.S. dollars, but also stabilizes the level of employment in the United States and globally. So that I think when we're talking about international currency reform, international monetary reform, we have to remember it's not just about the dollar or the value of the dollar or the value of international dollar holdings. It's a question of the value of what is the major asset that every country possesses, and that is its labor force and its ability to use that labor force in order to generate national wealth. Thank you.
Well, we have time for a few questions, and let me start with the gentleman in the rear.
Hello, I'm Bob Blaine. I came in from Illinois for this conference, and I'm very happy to be here. I noticed that you're stressing stability. Suppose the prices are wrong, incorrect. What about accuracy as a property? The other thing is, you're speaking of an international currency. What about an international currency standard? The meter is the standard of length globally. My proposal is that we use the hour as the national currency, so it becomes an international standard of price. We are as if we were pilots without altimeters, trying to stabilize what could be a bad altitude. What about adopting a single standard based on time, because time organizes everything in the economy? Time is constraining us right here. Smith talked about the invisible hand of the market. The market is not organized by an invisible hand. It is organized by a visible hand, the hand of the clock. What about the hour for our international standard of price?
I would say let's use an hour of labor.
Yes.
I would agree.
I think there's a few mechanical problems that can be addressed, and that is there is an imbalance between U.S. saving and consumption, leading to a shortage of capital for investment, which we borrow back from those who wish to sell to us, i.e. we borrow from China and Japan, and as long as they wish to sell to us, they must accept those IOUs, and we will have a deficit which accumulates into a debt, which ultimately, over the last 25 years, has shifted from a $1 trillion net surplus to a $3 trillion debt abroad, and that will continue until Americans reduce their consumption and increase their savings sufficiently so that we don't have to borrow from foreign savings. So far, I have not heard you address that particular problem.
I'm happy to.
Well, let me just comment before our panelists might that reducing consumption would not help the U.S. economy. In fact, just the opposite. And a large part of our present policy is intended to support an increase in consumption through an increase in employment. So there may be kind of a conflict between that the idea you express and the way U.S. policymakers are viewing the situation here. Would any of the panelists like to
Yes,
comment?
I would like to address that. I began my remarks by saying we had a dysfunctional international monetary system precisely for that reason, and it was laid out brilliantly in the pages of the British of the Times in 1971 in September by Caldor, who said, if you have this kind of a system that we've now embarked on, the country will be forced to consume. It will lose its manufacturing. And he lamented that a nation of entrepreneurs, namely the United States, would become a nation of rentiers dependent upon the rest of the world. So it is a policy that we have adopted to allow the dollar to be the key currency, and these are the repercussions thereof. I say, for the sake of the U.S., we got to change that.
Yes.
You didn't really answer the excess savings guy here.
Oh, you wanted to answer?
Yeah.
Hello. I was wondering what you guys thought of the recent agreements between Russia and China for major development projects. and the effect of those projects on the dollar. As we all know, China holds a lot of what is potentially worthless paper if the dollar were to continue to drop in value. But what they've done in signing these agreements for nuclear power and high-speed rail is they've actually transformed that monetary dollar into something of a credit dollar, a dollar that's actually invested in physical productivity. Because, as we all should know, right, dollars don't have any inherent value in themselves. You can't eat them. They won't heat your house, at least not for very long if you're burning them. But they only have value to the extent that they're invested in actual productivity. So my question is what you think of China and Russia participating in these agreements and how we might actually get the U.S. to leave this idea of the dollar, pumping more dollars to save derivatives, or these floating exchange rates, buying and selling money to make more money, but to actually invest those dollars as credit in major productivity projects, nuclear power and other kinds of things.
Yeah, well, I'm not sure. Sorry, I'm not sure I will be good in my answer, but I'm not sure I properly understand. Looking from the China point of view, they absolutely need to use their sovereign funds. They have two needs. Use their foreign funds, that's their sovereign funds, to control natural resources. So they're looking everywhere how to do that, whether it be in Australia, there has been the negotiation about mines in Australia, whether it be in Russia, whether it be in Africa. And there is another tendency, and so the sovereign funds are made of dollar reserves. And on the other hand, there is an enormous effort, which is for objective reason, but also for symbolic reason, to avoid using dollars for exchange with neighbor countries, whether it be Russia or whether it be ASEAN. So you have the two moves, because as they are newcomers, they absolutely need to find their share of energy and natural resources. So they can do both ways. I mean, using their sovereign funds, using their exchange currency reserves, and negotiating contracts which escape to dollars. This is my understanding of your question, at least.
Yes. We have time for a couple of more questions.
Yeah, thank you very much. I enjoyed the presentations very much. I wanted to ask Jan, I thought his point was very interesting that, and I think Jane also hinted at the same, that a foreign exchange should not be anymore an asset. And he welcomed the measures like Brazil's to try and discourage flows. But I think that is a very good objective, to try and discourage speculation on foreign exchange. But is it enough for the recipient countries to try and control flows, or will they always get overwhelmed? And should this not be complemented by measures like we discussed in the first panel, of trying to discourage from the source countries like Japan or the US or whoever is generating the carry trade to have such large volumes of carry trade? And could one think of the kind of measures that we were talking about last night in trying to discourage the carry trade? And would that be an important policy agenda? And my second question relates to the final point that Jan made, which I thought was really interesting, that the reform should be aimed at not just stabilizing the value for the Chinese and for others of holding dollars, but of stabilizing employment. And if he could, in the short time left, spell out a little bit the vision that he has of a system that could achieve both of those objectives, because I think that's absolutely central. Thank you.
Would you like to respond?
I'm accumulating all sorts of things to respond to. Yeah. First of all, if we go back to, and this fits into the question that Stephanie asked, if we go back to this idea that somehow or other the United States is consuming more than its income or something like that. I mean, unfortunately, we are in a global system, and a global system is a zero-sum game. And as long as the United States is an open system, it makes no sense to talk about any individual country consuming or more or less than its income, because there is always a counterpart, someone, someplace, who is doing the opposite. So the question is, whose fault is it? And you are never going to resolve the question of whether or not the fault is too much saving in Asia or too much consumption in the United States. Although the chairman of the Federal Reserve, I think, has come down in favor of the explanation it's the Asians that are crazy because their savings too much, rather than the United States that is crazy because they consume too much. And as an American citizen, I'm very happy with that sort of explanation, because I am very pleased to continue to consume more as long as someone else is willing to consume less without charging me for it. So it is, as I say, it's extremely difficult to look at this simply in terms of national policy. And this is precisely why it is a question of international policy, and why it is a question of designing the system so that the system does in fact allow different national preferences to be expressed without generating a negative impact on global output and on global levels of employment. And this is basically the difficulty we said that Keynes was attempting to face in terms of providing an international adjustment mechanism which allowed for these excesses, whether they're excesses on the Asian side or the American side, to be resolved without introducing policies that on both sides had a negative impact on employment. And this is back to the question that Stephanie raised in the end, is just exactly how can we go about doing that. Now, one of the ways of going about doing that, I would suggest, and this goes to the question of open international capital markets, is that, now, take the example of the carry trade. The carry trade you are never going to eliminate as long as the head of the Brazilian Central Bank believes that Brazil requires a 9% real rate of interest in order to have price stability, and the United States Federal Reserve believes that the United States requires a 0.25 federal funds rate in order to provide stability in asset prices. So now carry trade is going to be there no matter what. And this is again this question of coordinating particular international interests. One of the ways of doing this is, number one, as you say, taking foreign currency, taking national assets away from being international assets. Question of how do we decide to finance not our consumption, but our investment? Do we need to borrow foreign savings in order to finance our investment? And in general, the answer to this traditionally has been no. It was the answer that was given by the Bretton Woods system, and this was something that was only changed when we went to deregulation and liberalization of international capital markets in the late 1970s and the early 1980s, primarily as a result of the petroleum crisis, not of any particular decision that these things were in fact good or bad. So if we come back now to this question of, well, can we invest these things in productive assets or not? Yes, we can, but we really don't lack domestic financing to do that. And I can still remember, 5, 6, 7 years ago, Alan Greenspan talking about one of his famous conundrums. And his famous conundrum was that after the recovery from 9/11, firms had accumulated substantial liquidity balances, profitability had been restored, and, conundrum, they simply were not investing. And at that time, I was privileged to participate in the IMFC meetings, and usually he would speak in the IMFC meetings in plain English rather than in Greenspan speak. And he would quite simply say, he said, look, I simply do not understand, because in every previous recovery, when the private sector has built up sufficient liquidity balances and restored profitability, they start investing. This time they didn't do that. Well, this is clearly an indication that they have the resources to do it. We really don't need those foreign financing. So the question really is, should we allow the kinds of international financial flows to exist that they do? Now this, I refer back to the too big to fail problem of an earlier panel. Too big to fail banks are usually banks that are global banks, okay? They're big because they operate globally, not necessarily simply because they have grown big domestically. Those big global banks are the institutions that intermediate the international capital flows. So that when we're talking about limitations on international capital flows, we're also talking about limitation on the size of banks and the ability of those banks to operate internationally. So to simply come to the end of Stephanie's answer, this is a question I can't give you an answer to. Keynes tried to give us the answer. He had a proposal which was a very, I think, efficient way of resolving that problem. He was unable to sell it because of divergent national interests. Now, it's interesting today, the interests of the United States are probably the reverse of what they were in the Bretton Woods negotiations, and it is now interesting that countries like China and other Asian countries have taken on the position of the United States. Whether or not that problem will be resolved any more easily with the United States on the other side of the argument, I'm not sure. But I think we do know how to solve the problem. It's simply getting international agreement.
One last question, if it is brief. Yes.
Yeah, I prefer to call it the Triffin prison now, but that's okay.
But in the answers to those we ran through, we heard suggestions about stabilizing assets, stabilizing labor value, and then somebody suggested time, and of course people left out the productivity, the talent of the people whose time you're. But all those things, I'm wondering why nobody mentioned stabilizing public purpose, since we're divided up into groups and national organizations. And so my real question is, doesn't this come down to all these economic conflicts, a conflict between public and private groups in each case?
Yeah.
And as you said, we just have to negotiate the international interests.
Yeah, I don't know if somebody wants to respond to that. Yeah, I absolutely agree. I mean, basically, what we're talking about is the interests of the general interests versus specific interests.
Well, I want to thank the panelists and the members of the audience who stayed to the very end, and we're right on time. A tribute to James Galbraith and the other organizers of